This week on Wealth Track, legendary financial thought leader Charles Ellis and award-winning financial advisor Mark Cortazzo show us how to cut sky-high investment fees to save money and grow our nest eggs. Controlling your investment costs is next on Consuelo Mack Wealth Track.
The company you keep is also the company we keep. Together we help provide a lifetime of guaranteed income and investment solutions.
Did you know you can take Wealth Track with you? You can watch full episodes, you can watch the highlights, or read the newsletters, whenever, wherever. Let me show you how. In your web browser, type in m.wealthtrack.com. That's it. So join Wealth Track whenever and wherever you can. Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. How much do you pay in investment fees every year? What is the actual dollar amount you pay to your financial advisor, let alone the mutual funds you own and the firms that have custody of your investments? How much do they really take away from your portfolio and its performance over the years? Well, according to a groundbreaking article by legendary financial consultant and Wealth Track guest Charles Ellis, investment management fees are much higher than you think. As Ellis points out, the little over 1% of assets paid by most individuals and little less than 0.5% paid by institutional investors are seen as so low that they are almost inconsequential. Well, it turns out they are anything but. As Ellis points out, investors already own those assets, so investment management fees should really be based on what investors are getting in the returns that managers produce. Considered that way, fees are much higher. Pension giant CalPERS, the California Public Employees Retirement System, earned just 1% on its $233 billion investment portfolio in the past fiscal year. If it were to pay the average 0.5 percentage point charge on assets under management, the fee would equal 50% of their return for the entire year. The financial toll investment fees take on portfolios over the years is stunning. Last year, financial advisor and Wealth Track guest Mark Cortazzo introduced a flat fee portfolio product for individuals with smaller and less complex portfolios than his usual high net worth clients. He compared the 10-year costs for two clients, each with a $500,000 portfolio. One paying the not unusual annual fee of 1.5% of assets, to another, a flat fee client paying his $199 a month charge. With all other things being equal, the flat fee portfolio saved more than $80,000 in fees over the 10-year period. Well, this week we are going to examine investment fees and how you can reduce them with Charles Ellis and Mark Cortazzo. Financial thought leader Charlie Ellis is a world-renowned investment consultant to governments, institutions, and the financial industry. He has authored or co-authored some 18 books, including the investment classic Winning the Loser's Game, and more recently with Princeton economist Burton Malkiel, The Elements of Investing. And he is devoting a great deal of his time to helping individuals become better investors. Mark Cortazzo is founder and senior partner of Macro Consulting Group, a 20-year-old financial advisory firm catering to high net worth and now Main Street clients. Mark has been recognized as a top advisor by Barron's, Worth, and Fortune magazines, among others. I began the interview by asking Charlie Ellis how much higher investment management fees are than we think.
It depends on what you're thinking, but most people, honestly, most people think the fees are roughly 1%. That is low. Compared to anything else, you buy and sell a house, 1% commission, you think, my God, that's really low. It just doesn't happen that way. And if you look at it that way, fees are low.
Right, and it's 1% based on the assets under management,
right.
For instance. So you have a $100,000 portfolio, it's a $1,000 fee. Nothing.
Right. The problem with that way of thinking is it doesn't reflect any economic reality. For an example, if you're an investor, you already have the assets. So you're not getting the assets, you're getting something else. What are you getting? You're getting a return on the assets. Okay, so what's the fee on return? If you take the kind of return people are expecting from the now out over the next 10 or 15 years, you're paying about a 15% fee. That's not low, that's a pretty high fee. That's twice as much or more than most people say would pay for a house sale or transaction. It starts to look like a pretty good profit margin even for a pharmaceutical company. That's a lot. But that's not the right way to look at it, and that's not the whole story. It's actually a great deal higher than that.
So, Mark, you run an advisory firm, and you have seen what a lot of your competitors are doing as well. And basically, the 1% of assets under management as a fee, that's the standard, right? I mean, some are higher. So what's your response to Charlie's critique that in fact fees are much higher than you think when you just look at the returns you're getting?
I agree, and I think that the 1% is even wrong. We've had a lot of people come to us to review the fees on their portfolios to compare to what we're doing, and they have $1 million account, and we asked them what's their fee, and they said it's 1%, because at $1 million the fee goes to 1%. We looked at the fee schedule, and it was actually 2% for the first $250,000, 1.75 for the next $250,000, and 1.5 for the next $500,000. And when we did the math, on a $1.1 million account, they thought they were paying 1.63%. So it was 60% higher than what they thought was 1, which in and of itself might have been a very high cost for a $1.1 million account. So,
and is that common practice, do you think,
it is
in
the
industry?
most common fee structure that we see at big brokerage firms and investment advisories is a blended, not back to $1, it's a blended fee, where we think that it's not obvious to the client what they're paying.
One thing you should pay attention to is if you went to Canada, the fee normal would be something just over 2%. And if you go to all the major countries in Europe, it ranges between that 2% and 1%. If you go to Japan, it can get even higher. So our fees are low relative to the world norm and behavior.
And that's a change, Charlie. You have been in the financial business for 50 some odd years. You started as a very young child. And it was not always this case. So I mean, how did we get here? I mean, how did we get to where 1% is the norm, and even that's not real?
Well, for 50 years I've been working with investment management firms, and the basic metric has always been the same. You can increase your fees, and if you do increase your fees, nobody seems to mind, and you can increase your fees again, and nobody seems to mind, because everybody says you would never comparison shop for price if you needed brain surgery. If your family was faced with a major lawsuit, you wouldn't concentrate on the price of a lawyer. You're looking for skill, and if you want to get great skill, you have to be prepared to pay up. And those who traditionally have had the lowest fees for active management have been not particularly skilled and not particularly well represented as to what their capabilities were. So we looking for value. We look for best indication of value in most markets is price. So we are prepared to pay a price in order to get good value. After all, my family is dependent upon it. I'm dependent upon it. I want the best. And if you want the best, you pay up.
So where is the flaw in that argument now? Because you have said that in fact the market has changed now. And so buying the best, whatever the best is, the best has changed. So how has the market changed, in which case that model doesn't really work anymore?
Well, the main change is there's so many truly wonderful, brilliant, hardworking, well-educated, slaving away at it, people trying to beat the market, that there are just too darn many of them for any one of them to be able to do better than the crowd. And if you believe, as I do, in the value of prediction markets, there's been no prediction market in the world with as many people putting real money into it and really doing the research and being free to make any choice they want to make and working at it all the time. So they got it pretty well right. Not perfect, but so much better than it ever has been before that it's very hard for anyone to do better than the crowd. And it's even harder to figure out who is it going to be before it happens.
So you have a different approach at macro consulting, the way you treat different asset classes.
Yeah, as a extension of what Charlie was saying, trying to define who's going to be the best manager, you're starting to see a lot more model portfolios that are using indexes as their base to invest the portfolios. So my 60-40 mix of index-based funds isn't going to have a big fundamental difference in performance versus somebody else's 60-40 mix. We're buying the same indexes in the same asset classes. The average fee for a $500,000 account, national average, is 1.5%. We, as well as other discounted firms, are at about 0.5% for that $500,000 account. And at $1 million, that 1% fee, there's plenty of firms that will manage an index portfolio for 0.25%, and that's a big difference net in your pocket. On the low return, one of the things that's very frustrating for us is we see people coming to us with fees that are 1.5, 1.75%, and they have half their money in fixed income, and the 10-year Treasury is at 1.5, 1.45. Their fee is more than their yield. So, to Charlie's point, not 15%, it might be 100% of the earnings on half their portfolio is the fee. And so we've talked to clients about culling out part of the portfolio, put it in a money market. Money market, you can shop it around, get 1% net, FDIC insured, and then have the equity portion managed, or an 80% equity portfolio managed, where you're reducing your fees and you're reducing your risk.
So Charlie, are some of the most influential institutional clients, probably at your behest, starting to question the fee structure? Is there any change occurring?
Gently questioning would be about as far as most people take it.
And why is that?
But there is a different way of answering a question, which takes us to what about active management versus passive management, which is a really important proposition. And if you look at the data, it's very clear that institutional investors and individual investors, but particularly institutional investors, have been increasing. The number who invest in passive has gone up and up and up every year. The percentage of their assets individually that goes into passive goes up and up every year. So two of the major forces are increasing steadily and never reversing. And the reason for that is partly fee and partly the imperfectibility of active management. So that if you really want to get a reliable result and you would like to save money in doing it, going to what bothers most of us as individuals quite a great deal. I don't want to settle for average in anything else. Why should I settle for average in this? It turns out that is not average. That is comfortably above average. This last year, for an example, 80% of actively managed funds underperformed the benchmark they were aiming for. You said, well, what happens over a long period of time? It's pretty grim again. Roughly 70% of funds have been underperforming over every decade. You make it 20 years to make it longer. The data's not so good. It goes up towards 80% underperform. That's a very powerful message, and people are getting it. And even though they'd like to have above average children and above average automobile driving skills and above average dancing skills, we'd all like to have everything be above average. The fact of the matter is, if you can have an average flight on an airplane, you'd take it. Because an average flight may be a yawner, but that's just what you want in flying an airplane. And in the same way, if you really want to concentrate on what's important in investing, you'll concentrate on what you're trying to achieve, how much risk can you take, and what basic kind of investing will do well. And then implement it through passive investing, either ETFs or index funds.
Mark, let me ask you about some other fees that we are not aware of. What are some of the most obvious that we should pay attention to?
When we built flat fee portfolios, we're trying to eliminate as many of the conflicts of interest as possible. And you look at many of the asset management programs that are out there, they're run by companies that are product manufacturers. So they also manage mutual funds. And so, we've had examples where someone would come in and they had 19 different mutual funds in their asset allocation model, and 16 of the 19 funds were a proprietary fund of the group that was doing the asset management. Now, there's 26,000+ mutual funds out there. They weren't the best in 16 of the 19 categories. So they're making additional soft dollar from the asset management fees. There are 12b-1 fees and additional costs that get passed on. And so the asset manager, if they're receiving any other sources of revenue from that program, their objectivity to pick the best funds is compromised because of revenue. And so the internal costs are very, very important to us. And when we do an analysis, we actually run that report for a client and say, here's all the funds, here's your expense ratio, and here's what you're paying internally in fees a year, in addition to the advisory fee. And it's usually a very surprising number to most people.
So what are the other kind of red flags or even yellow flags that go up that would be, if you're an individual investor?
At very large generality, the real problem for investment management, it was 50 years ago strictly a profession. It didn't pay particularly well, but it was interesting work and you could take some real pride in what you were doing, and you accepted it. It just didn't happen to pay very well. Over the last 50 years, as fees have been increased and the assets under management have gone up a great deal, and computerization has made it possible to manage substantially more money, the business pays very well. As a result, the focus on profession has gone down and the focus on business profitability has gone up. So you really ought to be watching, is this firm in it for the business side or are they in it for the professional side? And there are keys to the questions you can ask. What is the average length of employment of the people in your organization? How much do you invest in new people, training and developing their skills and capabilities? How much of your time, Mr. Account Representative, do you spend every year in training programs? If you look at the senior people in your organization, how many of them are professional people, how many of them are business people? And by and large, organizations that are widely known and widely regarded for investment management tend to be pretty serious about the professional side.
How about naming some names? What companies would you say really have set a standard of professionalism that you would feel comfortable referring an investment management firm or a financial advisory firm that you would feel comfortable referring?
We'll start with Mark's favorite and mine, Vanguard and DFA, two truly outstanding outfits. We can get into more detail on that if you want to. T. Rowe Price, outstanding organization. Capital Group, which manages the American Fund, outstanding organization. I know they've had in the last couple of years some imperfection in their results. Don't worry about it. They are a great organization and they will figure out what the problems are and get right back on track, and you can always trust them in the long run. Dodge & Cox is also quite a good firm.
I agree with virtually all the names that you listed. We use many of them, in our asset management for our high net worth clients as well as in our flat fee program. But every one of those organizations has areas where they're particularly strong. And working with an advisory group that's independent, that's not getting any money from any of them, can help construct an all-star team where you have each of those management teams do the position that they do best. And instead of having one fund family group managing every asset class within that portfolio, having them do their specialty, I think can help.
But Mark, that's what you would say because your business is to help sort it out and figure it out. You could also say any one of those firms as a family of different funds has a consistent integrity, consistent discipline, consistent professional commitment, and they're pretty darn good. So
Absolutely.
You could go either way.
Charlie, you wanted to make another point because the active versus passive debate, and Mark, I'm going to find out in a minute where you come out on that. But, and we've had this discussion before, Charlie, and I think it bears repeating because you have had 50 years basically of analyzing professional managers and to advise, clients where they should put big clients, where they should put their money. And it's been a battle for you as well as to, you finally said go passive. So what did you want to say about that topic?
Finally, the epiphany. You'd think after 40 years, you would get it. I didn't. 45 years, somewhere in there, I started to get it and realized. Part of it was by shifting from working with investment managers to working with clients of investment managers and watching what gets delivered, and you start paying a little bit more careful attention to it. Big, stunning surprise for me was to find out mathematically that most managers underperform the benchmark they're aiming for. Just happens to be the reality. Mathematically, nobody has been able to figure out who is going to do better in the future. Just can't be done. So, okay, that's pretty tough. What's the third thing? The third thing is those who underperform by twice as much as those who outperform. So that doesn't sound like a good deal. Then I'm looking at the numbers, meeting after meeting after meeting, and it finally comes on like a light bulb. That string of numbers that are called fees is pretty big compared to that string of numbers called your extra return. In fact, the fees are huge compared to the incremental or extra return. I believe what the managers ought to be doing is adding investment advice and counseling, because there the value is tremendous. Getting in the right direction, getting the basic structure right, that's really valuable.
So Mark, active versus passive management, where do you come out in the debate?
We also looked at the math, and if you think about this logically for a minute, all of the active managers put together are the market. So if you look at the collective performance of all active managers, their performance is the market. So the only differentiator is going to be their fees. So most index funds, the vast majority, almost 100% of them, underperform their benchmark. But it's by a very little amount, where the active managers, that divergence can be greater. And for people who don't want surprises, and good or bad surprises, I think that buying passive, it's controlling some of the things you can control. Passive has much higher tax efficiency. You can control that. The fees you can control. You can control where you own what you own. So you're taking a market that feels like it's out of control, and at least empowering yourself with the ability to adjust the things that you have the ability to adjust. So we have an active model portfolio that we manage for clients that won't take our advice to go to a passive strategy in our flat fee model, but we frequently have follow-up conversations with them to see if they've learned the lesson. So we think that for model-based portfolios over long periods of time, control the things you can control, and cost obviously is one of the big variables.
So the one investment for long-term diversified portfolio, and of course an investment can be an action that you take, whatever. So what would it be? What's the one thing that we should do, or the one thing we should invest in? Charlie Ellis.
Well, the best thing every single individual and probably every single institution can do is to sit down quietly and say, what do we really, really, really want to accomplish? What do we really, really want to avoid? And what is the most realistic way of getting where we want to go? That's probably the best thing anybody can do.
So very much back to basics.
Find out who you are, what are you trying to accomplish, and from there, it's not all that difficult to get a pretty good answer. And to getting a brilliant answer to the wrong question would cause lots of harm.
In the context of our fee discussion, minimizing the fees, is there one action we should take to minimize our investment fees?
Sure. Everybody who's an individual investor should be actively seeking passive management. They can do it with ETFs, they can do it with index funds. And the best known, most widely capable index fund managers are the ones to go with.
Mark, same questions to you. One investment, one action we should take for a long-term diversified portfolio.
I'm going to go with controlling the things you can control, and I'll give you 3 quick examples. Things like money markets. The average money market's paying 0.04%. You can shop that around and get FDIC insured money markets paying over 1% right now. So that's 25 times the yield. On your safe money, control the thing you can control. Making sure you're looking at where you own what you own. So tax inefficient investments, make sure you own those in the tax deferred accounts. Tax efficient investments, make sure you own them outside in your taxable accounts. And the third and most important thing is making sure that you understand what you're paying in fees in dollars as a percentage and relative to your portfolio size, and are you getting a good value for that? It is something that people spend a few minutes to try to save a few percentage on their auto insurance. That's hundreds of dollars. By taking the time to look at that and having it reviewed by someone, it could be tens of thousands of dollars, and maybe even a 6-figure difference, even on a more moderate-sized portfolio over time, because it's the effect of that compounding that's being sliced off with those higher fees.
Mark Cortazzo, so lovely to have you here from Macro Consulting, and Charlie Ellis from numerous organizations, author or co-author of 18 books, a new one on the way. Just great to have you on Wealth Track always.
Pleasure to be with you.
At the conclusion of every Wealth Track, we try to leave you with one suggestion to help you build and protect your wealth over the long term. This week's action point is the essence of what Charlie Ellis and Mark Cortazzo just discussed. It is know what your investment fees are and take steps to minimize them. Ask your financial advisor for an itemized list of the dollar amounts you are paying for all of their services, and the fees on each of your investments so you will know exactly what you are paying every year. If they won't do it, start looking for another advisor. If you manage your own portfolio, analyze the costs yourself or pay another investment professional to do it for you. It can save you a ton of money in the long run. If you have a 401k, you are in luck. All 401k statements are now required to show the actual dollar amounts you are paying in fees. And speaking of saving a great deal of money, during next week's fund drive for public television, we are rerunning our must-see interview with Social Security guru Mary Beth Franklin on how to maximize your Social Security benefits. If you would like to watch this program again, please go to our website, wealthtrack.com. It will be available as streaming video or a podcast no later than Sunday night. And that concludes this edition of Wealth Track. Thank you for watching. Have a great weekend and make the week ahead a profitable and a productive one.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally. Wintergreen, your home for global value. And Tocqueville Asset Management, contrarian investors combining independent thought with in-depth research.